This morning I'm going to be talking about a couple things, really. One is what's wrong with LNG pricing. So why haven't we seen more innovation? What are some of the issues there? Why is that a problem? And then I'll also share some what I think is some pretty interesting data pulled out of our LNG contract information service, which is a new product we have on contracts, LNG contracts, that actually give you some pretty interesting ideas about the value of things like flexibility and some of the changes that we're seeing in LNG contracts. So guess I'll just press on and begin with that. So, if you look around at energy markets globally, pretty much all of them have had sort of a series of benchmarks that are that are usually sort of directly related to the product. So crude, for example, has WTI, has Brent, and Oman Dubai. So you have sort of these three very robust indices that are used to price physical as well as paper markets. And the fact that you have these three sort of benchmarks enables you to hedge basically all kinds of different risks: timing risk, geographical risk, risk between regions. And if you look at most of the world's big sort of gasoline markets, naphtha, coal, for example, you sort of see that same structure where you've got direct benchmarks that enable market participants to price their commodity in a relatively transparent, liquid way and to manage risk pretty efficiently. LNG really doesn't have that. And there's some context to why we don't have that. I mean, I think the first thing is, LNG sort of used to be a fairly high priced club, is one way to look at it. Only wealthy countries could afford sort of the infrastructure, the production and import infrastructure that came along with LNG. LNG typically was only sold to creditworthy utilities who were typically operating in regulated markets under long-term contracts tied to crude. So it was a very neat package. But what it meant was fuel costs were passed through. So buyers actually didn't care about the price of LNG very much. Infrastructure, again, was financed, was project financed. So you were typically using other people's money to build infrastructure. Margins were pretty high all around. There was very little market risk. So it was actually a great business as the LNG market was sort of developed. And you wouldn't really change that unless you had to. But we're in a position now where the markets are changing. You've had structural change in global and national markets. And then, of course, shale really contributed to spoiling the party. So infrastructure has gotten a lot cheaper. You have a lot more countries that are able to import LNG either through FSRUs or small scale. You've had innovations in construction, both on the production side and on the receiving side. I think one of the biggest changes is that power markets in Europe and Asia are fully deregulated or being deregulated. So people really care about the price of fuels. And something else is that we've run out of big credit-worthy utilities in wealthy countries. So those are not the sort of new customers for LNG. And then, of course, U.S. producers disrupted the market, offering, millions of tons of FOB volume priced against Henry Hub at the same time as millions of tons of these sort of long-term contracts were expiring. So you've had all of this sort of volume coming out that used to be priced a certain way, that's now sort of finding its way into the spot market or short-term markets at the same time that you had more volume coming out of the US, which was very flexible. So, what you have is a situation in which LNG is very deep into the transition to becoming a commoditized market, but pricing of LNG so far has failed to evolve along with this transition. You know, I remember when I started at Poten, 6, 7 years ago, I was trying to figure out at what point LNG producers would shut in production. Was there a point? And one of our senior consultants sort of laughed and said, LNG is not elastic at all, really. He said you could sail an LNG carrier into Tokyo Bay and announce to the Japanese you were selling it for $1, a million BTUs, and he said no one would buy it. It wasn't under long-term contract. That's just not how things worked. But that has very much changed over the past 5 or 6 years. And I think these two charts really sort of summarize how that works and how things have changed and demonstrate the amount of elasticity that we're seeing. So what we're showing here is European import comparison and Northeast Asia import comparison. And so if you look at the 2019, 2020 numbers on the left chart, you can see in the dark blue, that was 19 and 20. Prices in Asia, in Europe rather, were higher. So you saw a lot of volume moving to Europe. And then you saw relatively less volume on the right chart moving to Asia. In 2020 and 2021, the situation was reversed, of course. We had that winter spike. We had, just in general, Asian prices have been higher. And so what you see is, European imports have fallen quite significantly in 2020, 2021 over the winter, and they've all moved to Asia. And that is purely a function of price. I saw the recent Gignal annual report. Their view is that 40% of the market is either spot or short term. And that volume is really swinging based on price. So price is increasingly allocating supply in LNG, and that's just not something that used to happen. So that's a really key factor on why we need better pricing and why it's a problem that pricing is an issue. This is a chart that I think many people are familiar with, and it really shows, I think, when the market broke, essentially, which was the fourth quarter of 2018. And that's really when the crude and natural gas markets globally sort of detached. LNG is really unique in that it doesn't, the LNG market doesn't really set its own price for its own commodity. So I sort of joke that LNG is the tail that the crude dog doesn't even know that it has. So every day you have global demand for crude is about 100 million barrels or so. But global crude trade on exchanges easily exceeds, 2 billion barrels a day. So you have this sort of massive crude market that is setting the price for about 60, 70% of LNG, and LNG has no control over how that market moves. Gas pipeline markets are closer to LNG, but still not the same. US and European gas markets are influenced by LNG imports, gas imports and exports. But what really matters is local production, pipeline supplies, particularly in Europe, from Russia and other places. That's what sets the market, not LNG. And so this use of multiple unrelated benchmarks really increases the risk. And you can see sort of how these prices move in sort of surprising, unexpected ways. I mean, you can see down here where we had last summer, where you had all of the gas and LNG prices converge. That's when you had all the cancellations in the United States. This winter, you can see we've never had a spike like that where JKM just sort of blew through Brent. I mean, you have seen JKM be higher than Brent on a couple of occasions, but nothing like the spike that we saw this winter. And that's really a sign of a market under stress. I guess, I sort of said mostly predictable before the fourth quarter of 2018. That relationship used to be able to count on sort of Henry Hub was the low price, and then you had TTF, the European spot gas benchmark, and JKM sort of really oscillating underneath Brent. Brent was always the ceiling. But since the fourth quarter of 2018, that's all really fallen apart. You just can't count on these relationships at all. And that creates all kinds of risk when you're trying to move volume from one region to the other. And LNG is really unique because the LNG market has almost no influence on the price of LNG, except with regard to JKM. And that's a really unique feature of the LNG market. I say this chart should scare everyone except traders. Traders thrive on volatility. So those unpredictable relationships create opportunity for traders. But they create, risk for just about everybody else. Aggregators, are essentially warehousing tens of millions of tons of LNG with all different kinds of price levels and pricing mechanisms. I say their portfolios are teeming with basis risk. You've got, TTF, JKM, Henry Hub, Brent, JCC, all different kinds of prices sort of mixed into these portfolios. It is their business model, and they are sort of best positioned to sort of manage those risks using the tools that are available today, and of course to absorb losses if they need to, and to take advantage of spikes when they can. But with that kind of diversity of pricing and volatility, I think it's safe to say that the aggregators, sort of take hits pretty constantly as you get this interplay of different prices. End users increasingly participating in competitive or deregulated power markets. So managing their fuel costs matters quite a bit. Margins in deregulated power markets are very thin. So if your fuel is too expensive, if you paid too much for LNG, you don't dispatch and you're out of luck. You don't make any money. And so, buying on Henry Hub and then selling power, for example, based on Brent, works well until, Brent is no longer the best price. If you look at producers, US projects look very attractive at one point. I think, but even the most competitive are kind of in the middle of the pack these days. Banks in the US have not really looked favorably on attempts to sell on benchmarks besides Henry Hub because of this basis risk. So it's hard to finance projects if you're trying to sell on a JKM basis or something like that. The other thing is, US gas producers pay taxes and royalties on a Henry Hub basis. So if you're trying to sell gas on a TTF basis, for example, and TTF prices sink, then you've still got to pay based on a Henry Hub basis. So your netbacks really suffer. So again, you're sort of taking a lot more risk on. You used to be able to count on those relationships, but JKM is not always higher than Henry Hub anymore. Brent's not always the best price. TTF has no direct link to power or gas prices in Asia or really anywhere outside of Europe. So if you're trying to price LNG on a TTF basis, but you're not selling into Europe, then you're basically, again, just along for the ride if TTF rises or falls in an unexpected way. Brent is kind of an interesting benchmark. It's clearly the most important benchmark in the world. It's used to price crude in Asia, West Africa, products in Europe, jet fuel all over the world, and of course LNG. It sort of made news recently, and I'll sort of talk about that in a bit. I think one of the things is that I've found in LNG that a lot of people are not necessarily fully briefed on exactly what Brent is, and I think it's not actually what a lot of people think it is. So Brent, I joke, it's not really Brent anymore. So it's actually Brent, what we call dated Brent, is actually a basket of 5 different crudes. You can see them on the right there: Brent, Forties, Oseberg, Ekofisk, and Troll. Brent is actually Brent Ninian these days. And so each of those grades is assessed separately every day, and the lowest price grade sets the price for the day. These days, it's usually Forties, which is setting the Brent price, and because it's heavier, a little more sour, so it's usually cheapest. The issue is, and this is from Platts, who sort of publishes the dated Brent price, is that you can see output is declining very sharply. By 2022, 23, we're going to be down to one cargo of crude a day, setting the world's most important crude benchmark. Existing fields are being pulled up, including the Brent field, so they're being decommissioned. There have been new discoveries in the North Sea, but generally they're too sour to be included in the assessment, too high in sulfur, so they would really pull it down. Platts, I say they've worked hard and used every trick in the book to save the benchmark. This has been an issue for a long time. Of course, it used to be Brent, and then over the years, and to increase liquidity or maintain liquidity, Platts has been adding other crudes to the basket, so Forties, Oseberg, Ekofisk, most recently Troll. So they've tried to sort of add liquidity by adding sort of more fields into the basket. One thing I think very few people are aware of is that Platts also introduced something called partials contracts to add liquidity. And what this is that you can sell 100,000 barrel sort of paper lots of crude into the market. And unless you sell 6 of them to the same buyer in the calendar month, you never have to deliver that. It's cash settled at the end of the month. So basically, you can sell crude without actually having to own crude or deliver crude. So that was another effort to increase liquidity by creating this sort of fictional crude that to add liquidity to the assessment. So I mean, they've really done bent over backwards to try to maintain liquidity. But you can see, geology is I guess a hard mistress, and you can see the crude's just not there. One thing that adding all of these crudes has done is actually sort of structurally lowered the price of Brent and of LNG. So 10% of Forties, for example, a 10% slope of Forties is just less than a 10% slope of Brent Ninian. So by adding these poorer crudes, you've actually sort of slowly eroded the value of LNG over the years. Some of you may have seen over the past few months when Platts announced, I guess at the end of last year, that they were going to make some substantial changes to how Brent was assessed. And they were going to do 2 major things. The first thing was that they were going to add WTI Midland into the basket. That's a grade of US crude, and I'll talk about that in just a second, what that meant. And the other was converting Brent to a delivered basis, delivered Rotterdam basis. So right now it's an FOB North Sea crude. They've been accepting sort of delivered into Rotterdam crudes for some time, but they were actually going to change the basis of the quote. So, on one hand, adding WTI makes a lot of sense. It's a similar grade to Brent and the other North Sea crudes. They also looked at adding West African grades to the basket. But adding WTI would have really significant impact. So one is that WTI Midland is a landlocked pricing point. If you've ever been to sort of West Texas, you can see Midland, Texas is really not very close to the sea at all. So it reflects sort of US mid-continent pricing. The estimates are, we did some modeling of this, is that, in a sort of backcasting way, is that WTI Midland would have set the price 20 to 50% of the time. So essentially by adding WTI Midland to the Brent basket, you're essentially making it a North American benchmark. And so that's a huge change. One of the sort of peculiar things is Platts had the option of adding WTI Houston, which is priced at the sea at a terminal outside of Houston, at the Magellan terminal outside of Houston. Platts didn't go for that. And part of the reason we believe that they didn't go for that is that that benchmark globally, WTI Houston, is controlled by a rival price reporting agency. So that essentially would have allowed a rival to start getting a piece of Brent, which, as I said, is by far the most valuable benchmark in the world. Certainly a sort of key sort of element in Platts's empire of prices that they report. The irony in some of this is that you've had some companies in Asia sort of say they don't want any more Henry Hub risk, they don't want any more North American risk. But of course, if you added WTI into the Brent basket, the sort of more conservative participants in the market who don't want more North American risk would end up getting much more risk anyway. Platts has sort of backed away from this. There was a big outcry, despite the fact that they'd sort of consulted with some people in the industry. So they're trying to figure out what to do. They're going to have to do something because, as you recall from the last slide, you're seeing sort of production in the North Sea just wither. And you're not going to be able to have a sort of robust benchmark if you just sort of keep seeing if they can't add more liquidity to that. Converting Brent to a delivered basis sort of adds more uncertainty to an already unstable benchmark. So LNG prices would be exposed to oil tanker markets, essentially by making this a delivered market. So again, that's sort of something you're adding sort of risks that really doesn't have anything to LNG. So, we've seen that there's still a lot of appetite in LNG to price against Brent. But, Brent is changing very rapidly. And there just doesn't seem to be anything that we'll be able to do to sort of avoid those kinds of changes. So this is something we're going to have to deal with going forward. So, what's wrong with using pipeline gas pricing? And I guess there's sort of nothing sort of wrong with it. I think for US supplies, it's the only way for most market participants to price LNG exports. As I said, banks pretty loath to loan to US projects unless, they're pricing on a Henry Hub basis. A lot of their expenses, taxes, royalties, things like that are on a Henry Hub basis. So it makes sense for sort of US exports. And if you're importing into Europe and you're not in line with TTF, so if you're not pricing in relation to TTF, then you're encountering, you're shouldering really significant market risk. If you're out of line, if you're higher than TTF, you just can't sell your gas unless you're willing to lose money. So to a certain extent, you've got to keep things in line with the markets where you're trading. But particularly in Asia Pac, pricing imports against the US or a North Sea benchmark just doesn't make any sense. I mean, the regional dynamics and seasonality patterns are different. There's no regional gas price in Asia. Brent is a global benchmark, but it's really the exception. So you don't have sort of a global gas price. And most markets, as I said at the beginning, have sort of several benchmarks that allow you to sort of triangulate and manage risk. Europe's also a very complicated gas market. Russian imports, local production. You have Azeri imports starting to come in, Algerian imports. So they have much bigger influence over price than LNG. And then Russia, of course, has periodically played politics with energy. And so, as an Asian buyer, you're sort of exposed to that if you're trying to price your LNG into Asia on a TTF basis. So again, you're sort of exposed to these risks that really have nothing to do with the price of LNG, have nothing to do with your market dynamics. So again, you're just kind of along for the ride if that's what you're doing. JKM is sort of the one LNG benchmark where we're seeing, real liquidity, real substance. Liquidity in the JKM market has grown quite a bit. I think we see some additional physical exposure. So particularly in the short term, 6 month strips, out to a couple of years, even a little longer now, you do see sort of physical exposure to JKM. And so that's partly responsible for the increase in paper volumes that we've seen on the ICE and CME exchanges. But frankly, a lot of that volume that we're seeing on those exchanges seems to us to be financial players who are trading volatility. That's not a terrible thing to say that there are speculators who are trading that market. Speculators provide liquidity. They enable people who are trying to lay off physical risk to do that. So I think that's a sort of valuable service that speculators provide. But you get a lot of complaints about JKM, and when you saw the prices sort of spike up above $30 over this winter, you got a lot of finger pointing that people were manipulating the market. I guess what I'd say about that, and my background is in price reporting agencies, is that most of Platz's main oil and refined products are set via similar processes. Most energy markets in the world are sort of pricing is set using sort of the price reporting agencies, similar processes, either, Platz's e-window, Argus does what they call intelligent assessment, where they essentially survey the market. I think, in most cases, the system works pretty well. In most cases, you have sort of derivatives that have sort of sprung out of these physical markets that allow market participants to manage risk. It's generally dominated by traders and majors. People complain about that a lot, but it makes sense because those people are the biggest market participants at the margins where the prices are set. So the fact that traders and majors are setting the prices, seems to me to be a reasonable outcome because those are the people who are bigger participants in the market. Other price reporting agencies use different methodologies, and the industry can choose to use them or not. You do need a sort of consensus among the industry to use a particular benchmark. But what ends up happening is, particularly in LNG, the market's pretty illiquid. So whatever complaints there are about JKM will just be sort of echoed on an Argus or an ISIS basis, because the illiquidity of the market is the issue here, not necessarily how you're pricing, your approach to pricing the market. The problem with PRA prices is that aside from exchange prices, in liquid markets, and exchange prices are great. So if you've got an LNG price that's trading on an exchange, everybody should use that. That's a liquid, regulated, transparent price. But we don't have that kind of liquidity in the LNG market. No one's really come up with a better way to assess illiquid markets than the approaches that Platts and Argus and ISIS and the others use. And that's after decades and decades of experience. So, people sort of clamor for a different price, but, the market sort of has to decide and then sort of coalesce around some benchmarks to get more liquid pricing. I wanted to turn now to just some kind of interesting bits and pieces that, as I mentioned, come out of our LNG contract information service, just to kind of look at some recent contract trends. So this is just sort of, volume of SPAs in terms of tons. You can see we've actually had sort of pretty robust volume over the past, I think 2015 was really the low when we just weren't seeing a lot of movement. 2017 also fairly low. But, we've had sort of pretty solid, pretty steady volume of SPAs. What you can really see is the weighted average of Brent by the year signed. So, the average in 2020 was about 10.5. percent. The low on a DES basis was about 10.2%. It's pretty clear that we've sort of come off that floor of about 10.2%, and I'll show you some more recent data in a slide or two. So that's a couple of interesting things. I mentioned at the beginning that one of the trends that we're seeing is, traders and aggregators warehousing long-term supply. And you can really see it on this left chart here, where you can see sort of the volume of SPAs signed by buyer type. And you can see sort of aggregators, traders really accounting for, ever since 2017, just a growing share of the volume that's of SPAs being signed. So again, that's that sort of phenomenon of them sort of signing long-term contracts and then reselling that volume as spot or shorter term or under a variety of things. And that's a sort of interesting trend. I think what that means is that, traders and aggregators are going to have increasing sway in the market. And you can see we only look at this data only looks at contracts of 2 years or longer. So you can see the aggregators buying more and more volume, and they're selling on an outright basis. They're selling more volume, but as a share, you're still seeing suppliers, producers of LNG, maintain their share. So that's a couple of interesting trends there. One of the things I sort of showed you the LNG slopes for Brent. One of the things that we've done is we've taken hybrid contracts, gas link contracts, and crude link contracts and sort of converted them to cash, basically using the forward curves of JKM and TTF and Henry Hub and Brent to try to sort of make apples to apples comparisons. And you can see it's not just in Brent where the sort of price has been coming down. So the sort of outright price is not really particularly important. That's sort of a moment in time. But you can really see sort of how the contract prices have come down pretty substantially based on the year that the contracts have been signed. And an interesting sort of caveat to that, though, is if you look at the sort of contract start date, you can see there's sort of a decline here, 20, 21, 22, 23. Excuse me. And that's when the consensus had been that what you would see was a fairly oversupplied or abundantly supplied market. So those prices were coming down. But if you look sort of beyond 23, you can really see this sharp increase in price. And that's because, sellers were really sort of seeing a tighter market, 23, 24, 25, 26, which I think is almost certainly true. The next few years are going to be a much tighter period than the last few years. And so they were able to sort of defend their prices, basically, for contracts starting in those years. So I think that's a very interesting sort of insight that came out of some of this contract data. We'll give you some more sort of insights out of this contract data. So one of the things that people have been talking about for the past few years is flexibility. And so we've been trying to figure out sort of what's flexibility worth. And the level of detail that we have and the scope of the number of contracts that we have sort of gives us some insight into this. So we did, or I did, a fair amount of handwork where I sort of went through contracts from 2018 to 2020, and I looked for transactions that had sort of substantial flexibility included. So it could have been seasonal swings, unusual tolerances, particularly generous or onerous, cancellation rights, price optionality, things like that. And so I sort of sorted them and compared what the prices of those kinds of things were versus a sort of more inflexible price. And it was, I think, pretty interesting outcome. So you can see here, crude link deals with substantial flexibility averaged about 11.45% of Brent during 2018 to 2020. But if you signed a deal with sort of little flexibility, nothing special, price was about 11.1%. So that sort of flexibility, about 0.35, about a third of a point, is what you're looking for. So that's what you expect to pay for that additional flexibility. We saw the same sort of trend with JKM deals. So a flexible JKM deal averaged about JKM minus 9 cents, whereas a non-flexible JKM deal averaged about JKM minus 13 cents. So again, the sort of non-flexible deals, the unexceptional deals, were cheaper. Same with TTF, same trend, flexible deals, 100% of TTF minus 20 cents was about the average. For sort of standard TTF deals, averaged about 98.75% of TTF minus 23 cents. So if you're not looking for flexibility, you can save quite a bit of money. Hybrid deals in a way sort of buck the trend. But they're all kind of flexible. So we didn't see the sort of flexible versus non-flexible sort of trend in hybrid deals. But what we have seen is that hybrid deals in general are higher priced. So the crude component of hybrids averaged about 11.8%, compared to about 11.2% for Brent only contracts. And the gas components showed the same for hybrids. Again, that sort of, if you were flexible, then you were paying more. And if you were non-flexible, then you were paying less. So I think that's quite interesting data out of our contract database. Of course, clients would be able to see this at a company level, at a contract level. So that's something that some folks want to take a look at. So some interesting other odds and ends that are kind of interesting. Specified supply sources becoming a premium service. So specifying a supply source will cost you about 1.2 to 1.5% more than if you just sort of say, I'll just, I don't care where it comes from. It makes sense because portfolio supply gives the seller much more flexibility. So you really pay up. If you want it from a particular plant, you're going to pay for that. Tenders, much cheaper than bilateral negotiations. So the average tender slope was about 11.4%. The average bilateral negotiation, almost 11.9%. So again, if you tender to buy LNG, you're going to save about half a point. To be fair, though, many bilateral deals included specified supply sources. So that's one of the things that lifted the cost of bilateral negotiations. Another thing that we sort of looked at was Qatari strategy. The Qataris, of course, have decided to go ahead with their 4-train expansion and are threatening to do two 2-train expansions in addition to that. But one of the things we've seen is the Qataris for a long time resisted competing on price. I think you can see from this chart that that's no longer the case. The Qataris are competing on price quite aggressively. We've seen them go in 2020 as low as 10.2%. So they were willing to compete very aggressively to place supply. And I think with all the supply that they're building, that's a trend that we're going to see continuing. Another thing that we saw, these are just the deals that we've seen through April of this year. So this is just 2021. In some cases, with regard to prices, seems like we're going backwards a little bit. So we saw 10 SPAs signed for almost 11 million tons. They were all done against Brent, 100%. The average tenor was just over 9 years. So that's sort of continues a trend towards shorter average contracts. I mentioned the Qataris on the last slide. The Qataris won 4 of the 10 SPAs with an average slope of 10.35%. so far this year. So again, Qatar sort of continuing its very aggressive, I guess, approach toward the market, toward placing supply, or very competitive approach. The average for all the deals signed was about 10.8 with a high of 11.5. 6 of the buyers were end users, 4 were traders and intermediaries. So again, I think that trend of traders and intermediaries taking big volumes continues. There were a few interesting sort of bits and pieces in some of those. We saw one smaller deal that didn't have a pricing formula. So they're going to negotiate each cargo individually. We saw one where buyers wanted to have a price review every 2 years that included a formula that was sort of going to oscillate between JKM and Brent. That didn't end up in the final SPA, but that was kind of an interesting ask. And then we saw a 10-year deal that included a requirement for greenhouse gas accounting. And so that was a sort of interesting development. And we're seeing a lot more focus on sort of low carbon, no carbon LNG. I think, in 2019, we saw 3 deals. In 2020, we saw 6. And so far this year through April, we've seen 6 zero carbon or low carbon deals in LNG. So clearly, that's a trend that seems to be accelerating. So to wrap up, the question is, what does the LNG market need to become a mature market? What do we need to do in order to sort of get out of this sort of pricing cul-de-sac that we're in? Some things we're sort of making some progress. I mean, liquid spot markets. I think we have pretty liquid spot markets. 40% is as Gignal said. 40% is sort of short-term and spot markets. That's about what you get in oil. Most oil trades hand under term contracts, not under spot markets. So I think LNG is kind of reaching the range where you can say that the spot markets are liquid. What we don't have is sort of widely accepted, transparent LNG pricing. So those crude and pipeline markets move on their own dynamics. Often unpredictably, they will never represent the value of LNG reliably. I think something else that you need, risk management tools. You won't get that until you have LNG benchmarks. So right now you've got JKM is the only one. We are seeing some bidding and offering in the European LNG market. We've seen a tiny bit in the US and some in the Indian market, in the sort of Indian Ocean. So we're starting to see some attempts or some liquidity sort of moving toward that. But I think that's a real requirement for sort of progress in terms of pricing. Usually how this happens, and I spent 14 years working in price reporting agencies, is that a big player basically says, I'm going to sell on a particular index. And then smaller companies need to come, buyers need to come and say, okay, fine, I'll do business on that basis. I want to buy from you. And if you're only going to sell on a certain benchmark, then I will buy on that benchmark. So that's usually what has to happen. I think we're still waiting for that. I think one of the issues may be that we've got such a concentration of volume among a fairly small number of players, that there may be some reluctance on the part of some of the major sellers or aggregators to take that step. But that's really what you have to have is sort of consensus. And I guess, finally, a cautionary tale is that the best index doesn't always win. It's often the first one. So for example, JKM, people complain quite a bit about JKM, but the best index, JKM may not be the best, but it's the one people use. So that's often the sort of dynamics of the market. Whoever's first or whoever manages to convince a major player to use their index often ends up in front. So you often end up in a situation where what is a better quality index is not necessarily the one that everybody uses. So with that, I thank you for your attention. I think we have a few minutes for Q&A, so let me get some of the Q&A up. Let's see. So here's a good question. So physical trading platforms for LNG, is that a way of getting better transparency? You know, and they mentioned sort of Platts, MOC, GLX, Redwood, Comet's another one. You know, have those, is that a sort of way to get more transparency in? And I guess the answer to that is potentially yes. In coal, for example, you had a platform called Global Coal that became quite important. And it was a sort of hybrid of a trading platform and a online brokerage, essentially. So the thing is, having those sort of platforms, I think provides a certain measure of transparency. You often have to sort of bid and offer in the open on the platform, so you know who you're dealing with. You can kind of see the bids and offers evolve over a trading session or over the course of a day or two. So some of those, in some cases, those kinds of online platforms have proven to be useful. So that's so thanks for that question. Let's see. Somebody asked about carbon neutral LNG. What is that? How's the pricing of LNG decided currently? Usually how that works, carbon neutral LNG is really just LNG that comes with allowances. So it comes with carbon allowances that sort of offset the carbon emissions of burning the LNG. So usually the LNG is priced separately, and then the sort of carbon comes along with it and you pay for that. One of the issues in carbon neutral LNG is that there's a huge range of different kinds of allowances, and they price very differently. So the European market's been as high as 40 euros, I think, or so per ton. So very expensive. Not surprisingly, nobody has done a carbon-free LNG cargo using European allowances. The cheaper ones are Chinese forestry allowances. Those sell for sort of $1 or $2 a ton. And that's where most of what we've seen has been done, using those or allowances that were generated using those kinds of allowances from China or other places. Let's see. Yeah, I mean, one person pointed out, I think it's a reasonable point, is that the liquid spot market didn't help this winter in Asia when LNG couldn't get to the market in time, and you know, LNG is not has sort of physical constraints, and I think that's a fair point. You know, LNG infrastructure is so expensive that you just don't see people building a lot of spare capacity. And so even when you think you've got a lot of ships, you know, you got 30, 40 ships on a spot basis, those can sort of disappear over a couple of weeks. And the same is sort of true, you know, you've got spare capacity in Chinese terminals, but not during the winter. So, I mean, I think LNG is always going to face some physical constraints. I think that's just the nature of the market, though. And so I think that's a manageable issue with regard to the development of pricing. But you know, and every market has some sort of physical constraints that market participants have to deal with. So I think that's it's a valid point. I think it's worse in LNG because of the costs. You know, but I think that's you know, I think that's a sort of manageable problem. One last question I think we have time for. A couple of people asked about JKM, a little more explanation about JKM, about whether there's a problem of, let's see, can it be manipulated? What's the most obvious problems with the JKM mechanism? You know, it's funny because, you know, I was in that business. I worked for Argus for a long time. So I was a competitor of Platts. And I never had anything nice to say about Platts during that whole time. But, you know, now that I'm sort of on the sidelines of it, you know, I think the argument that the benchmarks are vulnerable to manipulation, I think, has always been made. I think the way to deal with that is that more people participate in the market. So, you know, I think one of the things that Platts always said is if you think the price is too high, then you should be a seller, because, you know, you could make money selling into a market that's too high priced. You know, so I think that in general, um, I made the point earlier that aside from the ideal price, the best prices come from exchanges. Nobody complains about WTI or ICE Brent because they're so liquid. So if you've got an exchange price, that's your best price. That's liquid, it's regulated, it's transparent, it trades in real time all day, and that's what you'd want. Right now, you don't have that kind of liquidity in LNG. So you're sort of stuck with, you know, the other approaches that you can use, and price reporting, you know, either through a trading window, which is Platts's approach, or sort of survey method, which is often Argus and ICES's approach, often produce very similar prices. I don't see the Argus LNG prices. My guess is that their assessments for the LNG market during the winter spike were very similar to Platts's. People were, you know, people weren't happy with the prices that JKM produced, but I don't think there's any doubt that people paid those prices for cargoes during that time. And I don't think there's much doubt that they could have bought those cargoes for less money during that time. So I think the issue is more with the earlier question that you had, sort of physical constraints rather than with the price assessment approach. So I guess that's my call on that. I will try to get back to you offline for some of the other questions. But I think that's all we've got time for today. So I'd like to thank you very much for joining us today. We'll have the slides available, as well as a recording of the webinar available for on-demand viewing. So again, thank you very much for joining us today, and look forward to seeing you at our next webinar. Thanks again.